Dear learners, today we are going to discuss on a new topic, financial management by financial management functions. Under this chapter, we are able to understand what is financial management, why this is necessary, what are the functions of the financial management, what are the objectives of financial management, and how financial management is effective nowadays in a today's business world. Main part in this chapter is the finance. What is finance? If finance may be defined as the money, a type of money which is used in the business, is called finance. Now we can say that the finance is the lifeblood of a business, because for the purpose of the investment we need finance. Each and every organization need finance. Okay, so under this chapter we can able to understand how financial management is able to mobilize these funds in the investment purpose. So we can say that the financial management is an integral part of overall management, which is concerned with the financial planning, selection of sources of funds, financing proper utilization of funds, and dividend policy in order to achieving the overall objective of the business. First part is the finance planning, second part is the proper utilization of funds, and third, that means the dividend policy. From this part we can able to explain the different functions of the financial management. From this definition we can say that there are three major parts of the financial management. The first part is the finance decision, second is the investment decision, and third one is the dividend decisions. Finance decision is the major part of financial management. That means under this head we are going to discuss in three major area. That means the first part is the making finance planning, that means the how finance is acquired. Next is the determination of optimum capital structure, and third one is the selection of sources of finance. Under the finance function, the first function is making finance planning. How finance is necessary? Already we have discussed that the finance is the lifeblood of any business. So to start a new business we need finance. So making finance planning is the main part under the financial management. So how can a financial planning is to be made? With the help of cash flow statement, with the help of cash budget, with the help of capital budget, we can make different types of financial planning. That means in future what we are going to invest in our business, that is called the financial planning. The second part under the finance function is that means the determination of optimum capital structure. This is one of the important part in the financial management functions. That means how our capital can be invested in the different areas. How can we determine our capital? That means our capital structure. We know that in capital can be acquired with the help of equity fund, with the help of debt fund. Okay, so there must be an optimum capital structure between the equity and debt fund. The main purpose of any business is to acquire capital, but behind the acquiring the capital, the main part is to increase the value of the business. That means the maximization of wealth. Wealth can be maximized with the help of increasing earning per shares. So optimum capital structure is the main part under the finance function. This can be explained with the help of an example. Under the finance function, the second finance function is the determination of the optimum capital structure, and this can be explained with the help of an example. How optimum capital structure can be obtained? Suppose we have rupees 1 lakh and we need rupees 1 lakh as an capital for our business. Okay, so suppose we have apart from that we have so many sources. That means the equity fund, under the debt fund. Under the debt fund we have two sources, that means a 10% debt fund and another one is a 20% debt fund. Now the question may arise, from which sources we need capital to determine the optimum capital structure. And from here with the help of an example we can see that suppose the EBIT, that means the earning before interest and tax of there are three forms, that means the form A, form B and form C, and the earning before interest and tax of all these three forms are rupees 25,000. And we need rupees 1 lakh from the three sources. Suppose form A, they obtain their rupees 1 lakh, entire rupees 1 lakh by issue of equity shares at the rate of rupees 10 each. That is the case of the Form A. In case of Form B, they acquire rupees 50,000 by issue of equity share of rupees 10 each and 50,000 remaining by the help of 10% debt capital. And the Form C, they acquire 50,000 by issue of equity shares at the rate of rupees 10 each and the remaining 50,000 acquired from the 20% debt capital. So these three firms acquire their 1 lakh from the different sources. Now, if the earning before interest and tax of these entire three firms are 25,000, 25,000, 25,000. Now from there we have to, first of all, we have to deduct the interest. In case of interest, in case of equity share investment, the interest is nil. In case of Form B, they have acquired 50,000 capital from the 10% debt capital. So that at the rate of 10% debt capital, the interest from this debt is rupees 5,000. And Form C, they acquired remaining 50,000 from the 20% debt capital. So they have to pay rupees 10,000 as debt on this rupees 50,000. So after deduction of the interest, the remaining amount, that means the earning before tax, is 25,000 in case of Form A, 20,000 in case of Form B, and 15,000 in case of Form C. Now from there we have to deduct tax. As present we have suppose that we have 30% tax, we are in the 30% tax bracket. So we have to pay, in case of Form A, they pay rupees 7,500 on this profit as tax, rupees 6,000, Form B pay rupees 6,000 as tax, and Form C pay rupees 4,500 as tax. Now after deduction of the tax, that means the earning after tax, that is given as A. In case of Form A is 17,500, in case of Form B it's 14,000, in case of Form C it's 10,500. And the number of equity shares issued in case of Form A is 10,000, in case of Form B is 5,000, in case of Form C is again 5,000. So earning per share is that means the earning after tax divided by number of equity shares. So in case of we can see that in case of Form A, earning per share is rupees 1.75. That means the 17,500 divided by 10,000. In case of Form B, the earning per share is rupees 2.80. That means the 14,000 divided by 5,000 number of equity shares. And in case of Form C, the earning after tax divided by 5,000 equity shares, that means the rupees 2.10. So from this example, we can see that the earning per share in case of Form B is higher than the earning per share of Form A and Form C. From here, we can see that the Form B, they collect their funds with the help of 50% from the equity share issue of equity shares and 50% from the rupees 50,000 from the 10% debt capital. And Form C, they acquired 50,000 from the equity shares and remaining 50,000 from the 20% debt capital. That means they have to pay a higher interest rate than the Form B in case of debt capital. So from there we can say that the firm can acquire their capital not only from the issue of equity shares or not from the acquiring amount from the paying huge interest rate. So from these three forms, we can say that the Form B has optimized the optimum capital structure. That means the collection of funds from the 10% rupees 10 equity shares. That means 5,000 equity shares at the rate of rupees 10. That means the 50,000 and 10% debt capital. That means the 50,000 from the debt capital. So this is the proper example of how a firm can optimize their capital structure. Now, the third part of the finance function is the selection of sources of finance. That means there are different types of sources of finance. That means the equity source, debt finance. Apart from that, the acquiring finance from the banking sectors. So these are the main sources of finance. Next function of financial management is the investment function. Under investment function, there are three major investment functions of financial management. The first one is the investment of collected funds. Second one is the proper utilization of collected funds, and third one is the investment of internal funds. Now, investment function is the major part under the financial management. That means the first part, we acquire capital from the different area. That means the achievement of optimum capital structure. That means from the different sources. Now suppose we have already collected different capital from the different sources. Now the main part is the how to utilize this capital. So before we need capital, we have to prepare different plannings. how much capital is necessary for the business, because over finance is also not good for the business and lower finance is also not good for the business. So with the help of proper finance planning, we can acquire capital from the market, and capital can be acquired with the help of equity fund, debt fund, with the help of different funds. That means the main target is to determine the optimum capital structure. Already we have discussed that the different sources are banking sector, equity fund and debt fund. Now this capital can be utilized with the help of investment functions. So investment function is the main part of financial management. Under investment functions, the first part is the investment of collected funds, and we have a full faith in this area. Next is the proper utilization of collected funds. In that part, it can also be shown with the help of an example. Now, under the functions of the financial management, under the second function, that means the investment function, investment of collected funds, that means how financial management utilize their collected funds. This can be explained with the help of an example. Now, in this example, we can see that suppose there are two projects, that is the project 1 and project 2. And the initial investment needed in project 1 is rupees 5 lakhs and in project 2 is rupees 3 lakhs. The estimated life of project 1 is 5 years and the estimated life of project 2 is 3 years. And from the 5 years, the cash inflow in the project 1 is that rupees 1,05,000, 1,20,000, 1,35,000, 1,50,000 and 1,40,000. These are the cash inflow, expected cash inflow from project 1. And in the project 2, the cash inflow are 1 lakh, rupees 1,50,000, 80,000 and 40,000. In the fifth, because the estimated life of the project is 3 years, so in the fourth year, in the next year, they cannot earn anything. So, and the PV of rupees 1 is at the rate of 10% discounting factor is 0.909, 0.826, 0.751, 0.683 and 0.620. So from there we can calculate the present value of the cash inflow. For the first year, the present value of the cash inflow is 95,445. In the second year, it's 99,120, and from there we can see that the total present value is 4,85,200 in case of project 1, and in case of project 2, that means the column 5, that is multiplied by again with the help of column 3, the present value of project 2 is 3,02,200. As we know that the initial investment needed in project 1 is rupees 5 lakhs and initial investment is needed for the project 2 is rupees 3 lakhs. So these are our present value and these are the initial investment. So after deduction, we can see that in case of project 1, there is a negative net present value, that means of 14,800, but in case of project 2, there is a positive NPV, that means a positive net present value, that means the 2,200. So from this concept, that means either the firm has to invest in project 1, either to invest in project 2, we can see that the project 2 gives us the positive NPV in comparison to project 1. So it is better to invest in the project 2 rather than the project 1. So from there we can see that under the financial management, how the funds are utilized and how the collected funds are utilized, that can be explained with the help of investment in the different project. Third part under the investment function is the investment of internal funds. Now the question may arise is, what is the meaning of internal funds? The internal funds are depreciation fund is a kind of internal funds, reserve fund is a kind of internal funds. Now business can also utilize this type of internal funds for the purpose of the investment purpose. And the third function of finance management is the dividend function. Dividend. The question may arise, what is the meaning of dividend? Dividend can be defined as a slice of divisible profit which is distributed among the shareholders, which is legally distributed among the shareholders, is called dividend. সেগুলো আমরা দেখতে পাচ্ছি dividend is a part of the divisible profit. So it's play a vital role in case of financial management. And each and every stakeholders by each and every shareholders invest their money in our company only to earn profit, only to earn the dividend. If they get dividend in a regular interval, so they are satisfied and the market prices of the share will automatically increase. And if the dividend distribution of the company is declined year by year, then it will impact the decline in the market price of that share. So dividend is an important part. Now the question may arise is how dividend is distributed, how dividend can be declared. There are so many areas of the dividend distribution, the declaration of dividend. There are so many factors that can be considered before the declaration of the dividend, and this can be explained separately in the financial management part under the dividend policy chapter. Okay, these are the main functions of the financial management. Apart from that, the next part is the objective of the financial management. What are the objective of the financial management? There are two objectives of financial management. The first part is the profit maximization, and the second part is the wealth maximization. Now, the profit maximization is the main part, main objective of the firm is to maximize profit. There are so many arguments given in the favor of the profit maximization part, and there are so many negative arguments is also given in the profit maximization part. So the main argument, that means the positive arguments given in the profit maximization part, is someone say that the profit is the lifeblood of the business. If we earn profit, then it will automatically increase our reserve, which may be used for the future expansion of the business. Apart from that, someone also argues that the profit is the lifeblood of the business. If we earn profit, then it will, with the help of profit, we can distribute dividend, because with the help of if we incur any type of loss, that will automatically decline the dividend distribution. So if we want to increase the earning per share, so we have to maximize our profit, because without maximization of the profit, we can't distribute the dividend. So there are so many positive arguments given in the profit maximization part, and there are so many negative arguments also given in the profit maximization part. The negative arguments is given in the profit maximization part because this is the ancient concept. Profit maximization should not be the sole objective of any business. These are the historical concept of the financial management, but now somebody thinks that this is not the profit maximization should not be the sole objective of any firm. So there are so many negative arguments is also given in the profit maximization part. What are the negative arguments given? The first negative argument is that, suppose in case of monopoly firm, if profit maximization is the sole objective of any business, then in case of a monopoly firm, they can produce less amount of their products and increase the prices of the product to maximize their profit. So this should not be the this should not be the main part of the profit maximization. Profit maximization should not be the main objective of any business organization by any business firm. Next is the wealth maximization. That means apart from the profit maximization, nowadays we have new concept of, that means the objective of the firm is the wealth maximization. What is wealth maximization? Wealth maximization is generally considered as, that means the increase of net present value of the business. If we able to increase the net present value of the business, that means the wealth maximization. How net present value can be calculated? The net present value is calculated with the help of cash inflow minus initial investment. If the net present value is the positive, that means our wealth is maximized, and if the NPV is negative, then our wealth is not maximized. That means we have to invest only in those areas where our NPV is positive. Now there are so many arguments given in the favor of the wealth maximization part. That means, well, if the wealth maximization should be the sole objective of any business, then the earning per share of the company increases, net present value of the investment increases. These are the favorable, that means the favorable arguments given in the wealth maximization part. Someone thinks that the wealth maximization technique is also not suitable for the business. They think that if we invest only in those business which will earn positive NPV, that is not suitable for the organization. Before investment, we have to think about the taste, favor of our consumers. We have to think about the consumers. We have to think from each and every part from our consumers' point of view. What are their requirements? What are their demands? What are their tastes? So we have to think about that. If there is positive NPV, that may be good for the business, but that may not be the good from the consumer's point of view. So many consumers demand only those products which may not attract positive NPV. So there are some arguments given in the negative part of the wealth maximization part. So the main objective of the business is the profit maximization as well as the wealth maximization. So from this chapter, we are able to learn that what is the financial management, what are the functions of the financial management. Functions of the financial management can be described in three parts. That means the finance functions, investment function, and the dividend function. and these three functions can be explained separately, and these are interrelated with each another. Okay, and next part is under this chapter we have to that we have already covered, that is the objective of the firm. That may be the profit objective of the firm, that means to maximize the profit or to maximize the wealth of the firm.